By now, you probably have heard that the Fed has increased interest rates, and you may be wondering, why would they do that? What does this mean? How is it going to impact me? So let's start with the how it's going to impact you. So basically, what this means is the cost of borrowing is going to go up. So if you're taking out a home mortgage, if you're taking out a loan to buy a car, student loans, things like that, all of these are going to cost more money based on this interest rate going up. Detrimentally and perhaps counterintuitively, your savings account with your bank, that interest rate will remain the same. Theoretically, that should go up, but it won't, simply because there's so much, or it's unlikely to, since there's so much balance currently in savings accounts, it's hard for banks to deploy it. So basically, you're going to get dinged on taking out new loans for things, and you're not going to receive the benefit on your savings accounts. From a macro perspective, why would the Fed want to do this? Why would our government take this step? Basically, the number one thing is that they're trying to quell inflation. So you may have noticed that, I guarantee you have noticed that things cost more today than they did a year ago, and they cost more than they did a few months ago. Think about how gas prices have gone up, food, all kinds of things are going up, cars, houses, all of this stuff costs more. Inflation is kind of running away, and it is the byproduct of what amounts to too many dollars chasing too few goods. And we got into this place, whereas over the past few years, our government, in response to the coronavirus pandemic, has deployed more capital to kind of smooth out the economy, to help people in need. So think about your stimulus checks, think about your bailouts for businesses, so on and so forth. At the same time, we've also experienced some supply chain issues. So think about microchips or microprocessors being in short supply, which means we can't make as many cars as we want, we can't make as computers as we want. So you're having supply chain issues, which means there are fewer goods to purchase, but there are more dollars to purchase those goods. This market force kind of raises the price on things. So fundamentally, inflation goes up, the cost of good goes up, and inflation goes up. So that's what they're trying to stop. The reason why we want to stop inflation is it makes it difficult for individuals and companies in general to think about future finances. So if you're trying to save for your retirement and you're targeting, let's say, an 8% return or a 10% return, if inflation is 6%, your 8% return is actually functionally a 2% return, which makes it difficult to really plan for that, to figure out how much money you need to put in there. It also disincentivizes savings. It also disincentivizes paying off debt. So if you have a home mortgage at a low rate and inflation is ramping up, it behooves you not to pay that loan down too quickly, because you know that in the future money will be worth less, and your rate on your mortgage is less than the growth of inflation. So these are not really things that we want to encourage so much. So it's something that our government's pretty involved in kind of controlling, keeping down. It also makes sure that the dollar is a good source of commerce across all channels. But be on the lookout for that. So you're going to start seeing, your mortgage rates going up. If you're refinancing or buying a new home, you're going to see your car prices going up. But the idea is just to pull money out of the market, pull it out of demand, to essentially help stabilize, prices and help reduce the speed at which they increase. So I hope that helps explain a little bit and how it impacts you, and what you should be thinking about.